Well, thank you very much, and hello, everyone. So, what I'm going to do over the next little while is basically go over the big picture view. I'm going to look at the national economy before I hand it over to Rob to dig more into to the regional outlooks. So, if we could turn to the next slide first. I thought I'd start off very big picture. Since it's a relatively new development, just take a quick look back at the federal budget and in terms of what it might mean for the broader outlook. This is really the first time in a year and a half that we've had a federal budget. It certainly had a huge buildup going into it. The finance minister talked about it being generational. The prime minister talked about it being transformational. I think perhaps the budget somewhat suffered from being oversold, but there's no question it was a very important document. It really continued a series of steps that we've seen throughout this year that were mostly aimed at trying to strengthen the Canadian economy against the backdrop where we've just been faced with tremendous trade uncertainty almost since day one of 2025. And if I could just sort of stand aside for a minute, when we think about the really big picture, in a nutshell, I think this past year has been dominated by two themes. Through most of the first half of the year, we've been dealing with all the trade uncertainty, and through the second half of the year, we've been more dealing with all the implications around the heavy duty AI investment that we've seen in the US. And I would say overall, what we've seen is the economy as a whole has, whether you talk about Canada, the US, or globally, has probably held up a little bit better than we would have expected given all the trade uncertainty. But going back to the budget, really, the main feature here was to try to support the economy through the trade uncertainty. We've seen huge spending in areas like infrastructure, defense, and support for businesses that have been affected by the tariffs. And that's the main reason why the budget deficit has gone from an expectation of around $40 billion a year ago now to almost $80 billion because of those many different spending categories that the government has had to aim at over the past year. I've heard a lot of concern about the size of the budget deficit. When we think about it as a share of the economy, it will weigh in at about 2.5% of GDP this year, and the aim is to get it down to 2% next year. I would characterize that as manageable. It is sustainable, but I wouldn't really want to see that size of deficit repeated for long. So in other words, ideally the deficit after a lot of extreme circumstances this year will be headed a little bit lower next year as the economy improves. So if we turn to the next slide, let's just recap. Where are we in the trade war? Like where do we stand now? It's almost like you need a program to keep keep count of the many different ebbs and flows we've seen in the trade war. And I would say we're not as bad as it appeared earlier this year. The Prime Minister likes to say that Canada has the best deal in the world. The average U.S. tariff rate on Canada is somewhere between 6 to 7%. So, just a quick reminder: a tariff is a tax on imports, and broadly, the U.S. is applying an average tariff rate on everything that it's importing from the rest of the world at about 17%. Now, on goods from Canada, it's closer to, as I said, 6 to 7%. So it's not nearly as bad as we thought earlier this year. It's very focused on some particular industries, some of the ones you see in front of you. For instance, most steel and aluminum sales that we make to the US are faced with a 50% tariff. Autos, it's the headline number there is 25%, but it's only on the parts of an auto that are not US content, and we calculate that's about half of the value of a vehicle that would cross, say, from Windsor over to Detroit. So that means the average Canadian vehicle is facing a tariff of something like 12 to 13%. And also, when we look at the West Coast and in Quebec, our lumber exports to the US are being faced with a 45% tariff. So really the trade war is focused down to just a few certain sectors of the economy. These are important sectors of the economy, and they're hurting those sectors a great deal, but it is, again, a relatively narrow slice of the economy. So how is that affecting the economy? Well, let's turn to the next chart and just look at how sentiment is being affected. Now, these are relatively longer term charts. They take us back almost 20 years on consumer and business confidence. And what we see there is both businesses and consumers were about as bleak and negative as we have seen in the last 20 years earlier this year, when almost every headline was about the trade war that we were having with the US. But that's the bad news. The good news is on both fronts, whether you look at the consumer or businesses, we've seen much, much better sentiment in recent months. I would characterize both consumers and businesses is still being really cautious, but not nearly as negative as we saw earlier this year. Oftentimes, when I go to speak to groups, right across this country, I like to poll the audience and ask them, do you think the Canadian economy is going into recession? It's very interesting. Earlier this year, I would say it was almost unanimous among almost every group I talked to. They thought we were going into recession for sure. And more recently, I've seen a much better sentiment across much of the country. I'm not saying people are particularly optimistic, but they're not nearly as pessimistic as we saw earlier this year. And that's exactly what you see in front of you on both the business and consumer sentiment charts. So if we turn to the next chart, what do we actually think this means for the economy? Let's put it down to one number, and that's the overall growth rates we see for Canada and the U.S. I guess I would characterize this as growth of just a little bit more than 1% after inflation in both this year and next year for Canada as being a bit below average, but it's not a recession. So if I were to answer my own question, do I think the Canadian economy is going into recession? I think, my view would be is we've managed to just avoid it so far, and we're unlikely to go into one in 2026. It's been a struggle, no question. As I said, growth has been well below average. We actually saw an outright decline in GDP in the second quarter of the year. But the economy did stabilize over the summer, and we've actually seen some encouraging signs recently that things are mildly improving. And when we go into 2026, we are actually looking for somewhat stronger growth in 2026 than we had in 2025. Again, it is still below average. It's not strong by any means. But I would say, given where we were early this year, this actually is a little bit of a win. What's holding up the economy? Well, some of it is that the consumer has actually done a fairly good job of this. The average consumer has actually, done what they could. We've seen a lot of buy Canada. We've seen people traveling closer to home, and that actually has helped support consumer spending. The other factor here is, as I mentioned earlier, the government has spent a lot of money, and there's no question that that's also overall supporting growth. Just a quick word on the U.S. outlook, by the way. Look, nobody wins from a trade war. We have seen a slowdown in the U.S. economy over the past year, but partly because of that very strong investment in AI, we're looking at growth that's actually not far from average in the U.S. Both this year and next. So if we turn to the next chart, please. Um, even though the economy hasn't managed to avoid a recession up to this point, we've still seen, on balance, a clear weakening in the labor market. And usually, this is a really easy way to judge how the economy has fared. And what we've seen is the unemployment rate has crept up pretty steadily over the past year. Keep in mind, coming out of the pandemic in the summer of 2022, we saw the lowest unemployment on record, or at least in recent times, in Canada when the unemployment rate got below 5%. More recently, it's crept up closer to 7%. But in the most recent months, we've seen that unemployment rate actually dip a bit. Saw very strong job gains in both September and October, and that suggests that, as I said, that weakness that we saw in the spring around the most intense period of uncertainty on the trade front, the mood might be lightening a little bit, and that's even among employers. Now, looking over the next year, we expect the unemployment rate to nudge a little bit higher over the first part of the year, probably moving a bit back above 7%. But then as we get later into 2026 with somewhat firmer growth and much slower population growth, we believe that the unemployment rate actually will start to come down in the second half of next year. Now, one thing I would like to highlight is the reason why the unemployment rate has risen is not so much that people are losing their jobs. We don't hear about that many mass layoffs or big layoff announcements. It's really more a story that newcomers, whether it's uh, recent arrivals to Canada or students or young people, are struggling to get their foot on the ladder. They're struggling to get that first job or holding on to that first job. And if you look at the line on the bottom, you can see that the youth unemployment rate is now above 14%. That's not an all-time high. It's actually backed off a little bit in recent months, but historically speaking, that's definitely on the high side and really drives home the point that it's newcomers and young people that are struggling to catch on to this labor market. If we could turn to the next chart, please. If there is a silver lining to that weakness that we've seen in growth and that rise in the unemployment rate, is it has helped contain inflation. Now, if I was giving this presentation a couple years ago, this would have been the first chart. This is what I would have started with because inflation really was the dominant story as recently as a couple years ago, and we've seen a big improvement. We're almost back to normal on that front after a very unfortunate upturn in inflation through 21 right up until 2023. But I would say the key word there is almost. We're still not quite back to normal. So recently it was reported that Canada's headline inflation rate rose just a bit more than 2% in the month of October. And keep in mind that when you hear that headline inflation rate at 2.2%, that is a snapshot in time. That's looking at the rise in the price of a basket of goods and services over a 12-month period of time only. So the October inflation rate for 2025 is looking at prices in October 25 versus prices in October 2024. It tells you nothing about what happened in the years before that, the big run up in prices that we saw in the years before that. Again, it's just a snapshot in time. Now, if you look at that chart on the right-hand side, the table on the right-hand side, you can see that, basically all major Western economies went up together back in 21 and 22, and we've all come back down together in the last couple of years. There's a bit of divergence. The low end is, at least among the, I'm not talking about China here, but among the major Western economies, the low end is Europe and Canada in the low twos, and at the high end you see Britain and Mexico closer to 4%. But the big story here is everybody is a little bit closer to normal. Now, when we look out into 2026, we think inflation will stay fairly close to 2%. Our bias is that it'll probably come in a little bit higher than that. The real thorn on our side here is grocery prices and food prices. They were a big story a few years ago, and they certainly have not gone away by any means. So even though we are seeing some relief in energy prices, unfortunately, food prices are still a big story here. In fact, if we dig in a little bit more, if we go to the next slide, please, if we dig into what various components are driving that headline inflation result, this looks at different components of the basket. The prices on the left-hand side are things that have actually fallen in price over the last year, and items on the right-hand side are those that are really leading inflation. If you look at the left-hand side, well, what has come down in price? You can see the removal of the carbon tax earlier in 2025 is still playing a big role here. We've seen declines in natural gas and gasoline prices. A few other items. I always like to joke. I don't know what airline that StatsCan is flying on. That way, they've reported a decline in airfares over the past year. That does seem a little bit difficult to believe. I have to say. But one I will note is that decline in new home prices is real. We are seeing that in many areas of the country that home prices are drifting lower. But if we now turn our attention to the right-hand side, it's interesting that a lot of the things on the right-hand side are involved with putting a roof over your head. It's true that home prices may be drifting lower, but a lot of other costs involved in home ownership or even renting are still there, are still prominent features on the right-hand side. You can see, home insurance, property tax, rent have all seen pretty big gains over the past year and are still driving in inflation. But I mentioned grocery prices earlier. Coffee is right at the top of the deck, and I know many of us are horrified by the fact of how fast coffee inflation has been. But if you look down at the bottom, you can see groceries are still there. And if anything, we believe that grocery prices will remain, as I said, a real thorn in our side over the next year. We're looking at an average grocery price of somewhere between 4 and 5% in 2026, which will keep inflation a little bit uncomfortably high as we go through the next year. Now, if we go to the next chart, please, what does this mean for policy? So, what does it mean for the Bank of Canada that inflation is going to remain a little bit sticky, especially led by grocery prices? Well, I think what the Bank of Canada would tell you is there's nothing they can realistically do about food prices, and I do believe they'll largely look past that as long as it isn't spreading to other items. But we have had a tremendous cut in Bank of Canada interest rates since the middle of last year. As recently as the start of June 2024, the overnight interest rate at the Bank of Canada was 5%. We're now at 2.25%. So the Bank of Canada has more than cut interest rates in half in less than a year and a half. That is a tremendous pace of interest rate cuts we've seen. And the Bank of Canada has almost clearly signaled to all of us that they think that they are done cutting interest rates. or at the very least, they believe that interest rates are consistent with where inflation and growth is right now. That's a very clear signal from the Bank of Canada. I will say that we're not 100% convinced that the Bank of Canada is done cutting interest rates. They almost are. But given that uncertainty we still face on the trade front, the fact that the unemployment rate has gone up a lot, and that headline inflation is close to 2%, there still is the possibility that if growth surprises to the low side or inflation does better than or lower than what we expect, we still are holding out the chances that the Bank of Canada may feel the need to trim interest rates one more time as we move into 2026. But for now, we do believe the Bank of Canada is going to move to the sidelines and assess things before they go on. I will spend just a minute here talking about the US interest rate environment because they've been in a very different place than Canada because their economy has been a little bit stronger, their unemployment rate has been lower, and their inflation has been a little bit higher than here in Canada. The US Central Bank, the Federal Reserve, has been much more reluctant to cut interest rates at the pace that we've seen in Canada, and their rates are well above those in Canada. There is a lot more room for US interest rates to come down over the next year. And then on top of that, on top of the economic fundamentals, we have the X factor that we know the Fed chair will be replaced in the middle part of next year. And Mr. Trump is almost assuredly going to put in someone of the dovish persuasion. In other words, someone who is probably going to favor much lower interest rates. And we too are taking that into account when we look for a total of about another 100 basis points or another percentage point of US interest rate cuts over the next year. And so if we turn to my final chart, that actually does inform where we see the Canadian dollar going over the next year. Just to quickly recap, we see the Bank of Canada is being almost done cutting interest rates, perhaps one more, in an environment where we still see a lot more from the US. We do think that ultimately the US will cut interest rates, as I said, by about a percentage point over the next year. And we think that balance will take a little bit of pressure off of the Canadian dollar. Recently, it's been hovering around 71 cents or even a little bit below that. It got lower in early 2025, but that's still close to about the lowest level that we've seen in the last 20 years or so. And fundamentally, what this chart suggests is it's not really oil prices that are driving the Canadian dollar. That used to be the number one driver, but it really isn't the factor that it would have been 10 or 20 years ago. The main driver now for the Canadian dollar is what is the US dollar itself doing? And our view is that, while we've seen ebbs and flows in the US dollar in the past year, on balance, because the Fed will be cutting interest rates more aggressively as we head into 2026, we see some weakness in the U.S. dollar renewing in the year ahead. And the flip side of that is we do see the Canadian dollar rising slightly. Now, I do not characterize myself as being a bull on the Canadian dollar. I think when we get out longer term, it's going to really struggle to even get up to something like 75 cents. I think if we come back in a year or two, we're likely to find that the Canadian dollar really isn't that different from current levels. As I said, not that far from its lowest level in 20 years. So just to recap in a nutshell, I think the important point here is that while the Canadian economy has clearly struggled this year, I think the main point is that even with all the trade uncertainty, we did manage to just avoid a recession. And as we go into 2026, we are looking at a somewhat more positive economic backdrop, dependent on exactly what happens with the USMCA renegotiations in the year ahead. And that's it for the broad national picture. Thank you very much.